screen. Moment.
Die Stummschaltung ist aufgehoben.
Hear me?
Good morning, mate. Can you hear me?
Good morning. I can hear you perfectly fine.
Excellent. So let's see if we get the correct screen up and running. Hey, there's Dees. I was looking for you already. It's not quite the same if you're not here on a Monday morning. Good morning, traders. Good morning, Admiral. Thanks, guys, for joining in. I hope you had a very excellent last week. We did. We had, you may recall, still open our short Aussie versus New Zealand trade, and that was this morning at plus 78 pips. So we are seeing a technical bounce in Aussie this morning, so keep an eye on it. Maybe reduce some of your risk in the trade if you should be in it. In general, I teach my traders not to take anybody else's trade, but to learn the business and then come up with your own trade ideas. Why? That is the way to actually build a trading brain and to get very familiar how to do this job on a continuous week in, week out basis. And we make money every month. So this was a winning trade. And then last week we suggested to have a look at the long gold in US dollars. And that trade was a full winner with a 2-to-1 risk reward ratio, i.e. $8,650 per contract. $8,650 per contract. And sometimes I wonder if some of you guys realize what kind of value you're getting here for free. We make money for months now. We've been doing this for years. Every month we make money. We are extremely consistent in the process that we pursue because it is an institutional process. And you have to differentiate between market making at a bank, where your job is to provide liquidity to the large clients, versus proprietary trading at a fund, for example, a hedge fund, which pretty much is doing what we're doing, approaching the market with a fundamental / technical approach, a global understanding of the risk drivers, and a very, very strict risk management and a strong psychology. Anyways, let's get into the headlines of this morning. Sorry for that rant. Asian equities were red across the board. We had a severe sell-off on Friday on Wall Street. We saw weak PMI data in Europe and in the US. And so that caused a major risk-off sentiment. The front-month Treasury futures rallied 21 ticks. That's quite a bit, actually. We this morning, when I came to the desk, we had Japanese shares actually down 3.1%, and we had some strength in the yen due to risk-off flows. That was the biggest drop since 2019. We also had Chinese equities and Asian equities red across the board with more than 1.5% in the red. And in the bond market, we had Australia's 10-year bond yield as well as New Zealand's down at record lows, in Australia 1.78%. Japan's 10-year hit the lowest since September 2016, as the Bank of Japan suggested that they're changing their asset allocation mix. FX retail clients, by the way, with one of the larger FX brokers, had a record long position in Aussie New Zealand. At times, that can be quite a contra signal what the retail market is doing. Britain's parliament was suggested to vote on Tuesday. Now it's suggested to vote on Friday. Theresa May's Brexit deal. The EU granted the short extension to, I think it was the 12th. Oh, sorry for that. So the saga continues, but May's in a hot seat here. It's a jump seat. She has quite a revolt at her hands. Several ministers and a lot of commoners are against her, want her to drop out. She's getting some prominent backing in the overnight headlines for some to ask her to remain. Anyways, I'm working under the assumption that Friday the deal may pass. But it's very iffy, guys. It's really iffy, and even the ECB acknowledged over the weekend that this Brexit is the biggest threat to the Eurozone and the economic development over here in Europe at the time, and suggested that the market is underpricing the risk. And I'm getting a pretty crappy feeling here myself that the market may be underestimating the risk that we are facing with this. Okay, last time she lost by a wide margin, and last I read, that her meaningful vote may fail again with over 140 votes. Difficult. Probably you've read it in the news. Twitter is exploding with it. We've been talking about it for 2 years. Pretty normal stuff for us. The Treasury 3-month 10-year yield inverted on Friday. We actually see a steepener this morning in the market again during the European Open here, but it inverted. And why is that relevant? Well, it's relevant because the last 7 recessions in the US have been predicted by that indicator with 100% accuracy the last 7 times. But it needs to be sustained below 0 for it to materially matter, and just to look below 0 may not be that material. And also please recall that all our models are currently still signaling an above 2% GDP growth for second, third, and fourth quarter in the US for this year. To have a recession, you need technically 2 quarters of negative GDP growth, and the models are not suggesting that at all yet. The other aspect of this indicator is that it usually takes 12 to 16 months after it looks below 0, i.e. goes inverted, for a recession to materialize. What we definitely have is an earnings recession in the US. That's why I repeat once more, should you be long US equities, I would highly suggest that you start putting on some shorts to balance your overall risk, or go market neutral in your positioning by adding some hedges to your portfolio. It's getting quite dangerous up here, mate. Quite dangerous up here. 10-year Treasury yield this morning was at 244. Crude was trading below 59. And gold edged up another 20 basis points to 1316.52. My next interest to buy gold is anywhere below 1295. My preferred buy point will be 1290. We hit a sell zone and we are seeing some profit taking. Given the severity of the risk off sentiment here, gold has actually not gone as hard to the north as I would have expected. That obviously has to do with the dollar strength. The 2 themes in the market right now that are driving risk sentiment are Brexit and the US-China trade talks. Strength over weakness. When I hit the desk, we saw some weakness in the pound here, bottom left-hand side, and then some risk-off sentiment in the market with flows going into the yen. If I look over now, it's actually reversed. We are seeing flows into the Aussie dollar, Canadian dollar, and the euro. And we're seeing money coming out of the Japanese yen as well as the pound. So the pound is quite weak at the moment. Market's starting to price in a horrific scenario here. We only have 2 major events that I felt were worthy enough to produce slides on. And one is the New Zealand dollar and the RBNZ Wednesday to Thursday night. And we have the official cash rate and the statement, and the market is expecting the RBNZ to remain at unchanged 1.75, which for them is a record low. Please recall that last week we saw some softer data. We saw GDP growth quarter on quarter of 60 basis points, which was in line with expectations, but the RBNZ in their forecast had penciled in 80 basis points of growth, so that's an underperformance versus what they expected. We had weakening consumer sentiment, which I'm highlighting here. Please keep that on the radar. We had weaker milk prices, and we had weaker credit card spending on a year-on-year basis. Nevertheless, the market expects the RBNZ to take a neutral stance, or in plain English, data dependent at the moment. We also saw that annualized GDP growth in the second half of last year, similar to the rest of the world, was coming off. It was shy of 1.7%, and it was driven still by very solid consumer spending in the fourth quarter of 18. It was up 1.3%. So I'm highlighting solid consumer spending versus a very recent weaker consumer sentiment. I hope you're understanding what I'm trying to get to. Then the market is keeping an eye on the very tight labor market, but we currently are experiencing a slowing down in employment growth. So slowing down in employment growth, weaker consumer sentiment, yet the GDP growth was driven by consumer spending. Does it ring a bell, what I'm trying to get to? And then also recall that we have new minimum wage laws put in place, and businesses are expected to pass on these higher wage costs to the consumer. Companies are getting margin pressured. Global growth coming off, yet your labor costs are increasing, means your profit margins are getting squeezed. In order to cover your costs partially, you try to pass that on to your consumer, to your clients. So RBNZ is currently expected to remain on hold until late 2021, but there's still some residual pricing in the market where some of the larger investors and banks are expecting a 25 basis point rate hike in 2020. Once that were to get priced out of the market, you would see continued New Zealand dollar weakness. May not continue, but at that point in time, we would experience New Zealand dollar weakness. Okay? So it's very, very important to keep an eye on the consumer sentiment, the consumer spending, and the employment situation, because that will have a significant impact at the moment onto the RBNZ's policy and market positioning and expectations. If that weakens, I expect that 25 basis point hike expectation in 2020 to get priced out of the market, and New Zealand will see outflows. Very, very relevant. Next slide that's of relevance is the Canadian dollar and the Bank of Canada. On Wednesday, we have a trade balance that's expected to recover from the dismal minus 4.6 billion last time. And then on Friday, we have GDP month on month, which is actually expected to come in positive. That's quite interesting because we had 2 months in a row with declines. If it were to finally increase, that's a positive signal. So plus 10 basis points versus negative 10 basis points last time on a year-on-year basis comes out to plus 1.5% versus only 1.1% growth last time. We had why does it get to a positive number? Because we had solid manufacturing and wholesale reports recently, and also a rise in residential construction. RBC, quite an important bank when it comes to economic research for the Canadian dollars, continue to track first quarter GDP growth at plus 0.9% annualized. So that's less than the 1.5 for the last quarter, but plus 0.9 for the current quarter, which the bank observes would make it the second straight sub 1% quarter in a row. Not quite good. Looking ahead, the bank anticipates a pickup starting in the second quarter of this year, where it has penciled in an estimate of plus 2.1. For the US, we expect a 1.2 to 1.5% GDP growth for the first quarter 2019. I'm mentioning this because the two economies are highly correlated. And then a plus 2%, above 2% growth for all quarters of 2019 on the back of that. So we are seeing the potential for GDP growth contraction to slow down, i.e. potentially even reverse here towards mid of this year. Important to have that on the headline. So if oil were to stabilize with good numbers expected for the Canadian dollar on Friday, that could be a long option for you, but it depends pretty much on oil as well. Possible trade opportunity for myself for this week is short euro dollar. It's not very often that I trade that pair. We did have IFO numbers just now, early on, and we saw the German IFO business climate beat on a headline basis. We saw the German IFO current conditions beat on a headline basis, and we saw the German IFO expectations for new beat on a headline basis. That's the reason why the euro is currently at 113.25 trading. Good. Why not a long euro? Well, because again, I'm trying to teach you guys, you got to look into the numbers, the quality of the numbers. And the headline suggests that the manufacturing part of the German economy is still in contraction. And that actually supports a weaker or a slowdown in GDP growth for the first quarter of this year, not only in Germany, but also in the Eurozone, because it is the #1 economy in the Eurozone. So you always got to be aware of the headline number reaction in a pair or in a currency, but then also look into the quality of the number, or have some paid services if you don't have your own analysis model to actually have the analysis done for you. So back to the trade idea, short euro US dollar. Euro, we had very weak PMIs out of Germany and France on last Friday. And we even had ECB's REN overnight on the ticker acknowledging that Eurozone growth has slowed significantly and that they must be concerned. And I taught my traders this in our trading room, where I explained to them that there's a difference between a central bank being behind the curve and a central bank trying to be proactive. Very rare. But the last time the ECB came out and announced TLTRO and pushed out their rate hike, I don't see a rate hike at all, by the way, pushed it out into 2020, that was the ECB trying to be proactive. And in itself, that is actually a bearish signal when you come to think of it. If a central bank is trying to be proactive, that actually implies that the economic situation is worse than expected. Now, we did have Goldman on the tape this morning sending out research to their institutional clients where they stated the doom and gloom in the German economy is not as bad. And I think I said it here last time or the week prior. That's actually partially true because we did have some severe one-offs that caused a significant negative GDP print for the last quarter. Nevertheless, even the ECB is realizing that we are in a very horrific scenario, i.e. we're having GDP growth come off severely and we're having inflation come off severely. That's bad. That means you want to be long treasuries in these economies. Dollar, we also had PMI numbers on Friday that missed across the board, not contractionary by any means though. So if the rest of the world, ROW, is weak and getting weaker, that leads to US dollar inflows because everything is invested in on a relative basis. That's why I'm expecting continued US dollar strength. So it's not the short-term rates that the market is playing right now. It's the global scenario that the market is playing right now. The risk to the trade is a technical rally in the euro. The dealers have been positioned in a corner, and so that could materialize. Doubt it though. I don't think it's there yet, but it is a risk to the trade that I have on the radar, and or dollar weakness due to somehow the market switching potentially on a short-term basis to play short-term rates. Recall we have 3-year, 5-year, 7-year, 3 months and 12 months bill auctions. I think there's $136 billion being auctioned of new debt in the US this week alone. And I'm very interested. I had a discussion with my co-instructor this morning, Andrea, about that. I'm very interested where the demand will come in on the US curve because it will give me an inclination of what the market expects in terms of inflation expectations and risk on risk off sentiment. If we look at it on a chart, it's a pretty simple trade. Short around 113.50, take profit 112.50, 400 pips. And my risk is 57 pips, yielding a risk to reward ratio of 1.75. Where there's trade to get run over, I'm more than happy to reshort at a higher level, i.e. somewhere above 114. I would be looking for a short. But that's how it stands at the moment. I think it's been a long time since I was timely enough, 21 minutes, so that's exactly it. And Darshan, thank you for your feedback. If there's no more questions, guys, I wish you a good week. The calendar is not as heavy as last week, but we'll still be able to make some money. Have a great week. Thanks for showing up. I appreciate you. We appreciate you. Thanks to Admiral, and I hope you all have a very solid, profitable week, and I'll see you again next Monday if you want. Bye, guys.
Die Stummschaltung ist aktiviert.
Much, Jay. Thanks for the comprehensive analysis. Thanks to the audience for listening.